Welcome to a special segment on state of economy. We are going to discuss IIP data which has been just released, and this month it has come down at 4.1% versus 5.2% the last month. Now this push is coming from once again manufacturing. Manufacturing has stood at 4.3%. Which was last month at 5.9%. Interestingly, if you talk about the constituents of even manufacturing, that had remained quite supportive. 14 out of 23 manufacturing sectors have shown the positive growth in the month of March. To discuss this in detail, we have with us two eminent guests. We have guests with us lined up. Right. We have Sakshi Gupta as well as Anita Rangan with us to discuss in detail about IIP data. Sakshi, I want to come to you first. 4.1% last month. Comparatively, if you see, it is lesser than last month. But overall, you think that positive trajectory continues even as the West Asia crisis is unfolding?
Yeah, hi. Good evening. Thanks for having me on the show. You're absolutely right. I think that the IIP number that has come out, given the amount of uncertainty, the energy price, as well as supply shock, that the global economy was witnessing in the month of March, I think the 4% plus number is definitely very respectable for IIP growth. Although, of course, this is much lower than, what we've been tracking on IIP in the previous 4 months, where the print usually has been above 5%. A couple of points that I want to make here. One, of course, this data, if you compare it to the core sector data that we had got just a couple of days ago, where the core sector activity actually had contracted for March, I think clearly the overall IIP index being positive and the growth there being positive is something that is welcome and it is comforting. Secondly, the manufacturing activity, and if you look at production growth in March, if you peel down the data and you look at some of the sectors that have shown positive growth, you have base metals, you have auto, you have auto components, commercial vehicles, tractors, positive and improving growth in these particular major sectors, again speaks to the underlying momentum that has been there in the economy and perhaps was a saving grace for overall manufacturing production in March. Finally, I think there are two or three sectors where we are seeing some slowdown in production, possibly because of the West Asia conflict. I think one clearly is the fertilizer production numbers that have come out. Second is chemicals, and of course, petroleum products, where there is some sign of moderation or contraction that is being felt.
Right, Sakshi, Anita, how do you read numbers of 4.1? You think that the impact of West Asia crisis is yet to come?
I think some of it is already visible. As we saw in the, eight core industries, it was already visible. Fertilizers, crude production, all of this was already visible. Even in the IIP numbers, if you see, you do see some sectors are witnessing a moderation. I wouldn't say slowdown, but moderation. But the construction segment, if you see, is witnessing some bit of moderation. That could be because of the impact on, prospective incomes, or because of lack of, slowdown in availability of certain construction goods and so on. The manufacturing segment, especially metals and the auto segment, was already on a buoyancy much before, led by GST, and metals were already on a high for the last 6 to 8 months. So there it is not slowed down, but, prospectively, we have to see, that things can actually slow down in these sectors as well. From the impact perspective, if you see, electricity segment is just about 0.8%. So there you can actually clearly see the West Asia impact. So one, we cannot conclude from these numbers because the momentum that we saw before the West Asia war until Feb is possibly pulling through, especially the vehicle sales numbers that we saw. Underlying numbers were actually very robust for March, so which is continuing. But if we look at it prospectively, along with the West Asia crisis, this looming threat of El Nino is already on the cards. So we have to put both together. So earlier, whenever we had El Nino, we didn't have any other kind of crisis in 2023 other than, recovering from COVID. So, and plus we had the Russia-Ukraine, but it wasn't that as bad as what it was now in terms of energy shock. So put together, I think things prospectively, we possibly won't see the momentum sustaining going forward. It will slow down. That's what I would want to say.
Right, and reading just on numbers, Sakshi, how do you read manufacturing growth of 4.3%?
No, like I said, earlier, of course, all these numbers, yes, there is some moderation both on a month-on-month and YOY basis, right? These numbers are also coming on a very high base. We must remember that. So, yes, there is some moderation, but I think that the numbers have come in better than my expectation, and especially the core sector data that we got where there was a large contraction. I think those sort of extreme impact or moderation in activity is yet not visible, at least from the March numbers. So I think clearly the numbers that have come out, in my opinion, have come in better than my expectations, and do speak about some of the underlying momentum that was already building up in the economy over the last couple of months, and speaks about the absorptive capacity of the system in general, in face of, various global uncertainties and shocks that we are currently facing. That is not to say that the risk, is not high, as Anita pointed out. Of course, over the coming months, as the duration of the conflict keeps getting prolonged, of course, the concern is that, we might start seeing the impact, not just from a supply perspective or production perspective, but then eventually also on prices. So clearly the risk both from the West Asia conflict, and I agree in terms of, the impact of El Nino, how that plays out in terms of rural demand and therefore demand for things like tractors, etc. How some of these things play out are a risk for the outlook going forward. But for now, this is, in my opinion, not a very bad number.
Definitely not a very bad number. Considering the current crisis which is unfolding globally. But capital goods growth at 14.6% versus 12.4%. I mean, one of the few specifics where you are seeing actually growth is there. How do you read this, Anita?
So yeah, capital goods has been outperforming, even before this March number. So I think their momentum has been holding up, and especially, given that, even if you see the import numbers, particularly import data and all of that, you do see certain sectors where these capital goods related sectors are still, growing. So it's not to say that, West Asia is actually clearly given, as, Sakshi pointed out, it's not doom and gloom for India. There are certain pockets of the economy which still continue to perform, possibly even as BAU. A large portion of construction is still happening. You're still seeing a growth. So therefore, we see a moderation, but we don't see a slowdown is possibly the positive spin. And even going forward, compared to many other economies, I think where India gets the cushion is perhaps the fact that, underlying momentum before this has been positive. Therefore, the cushion going forward will be slower. I think that's where you should take the read from capital goods particularly. So there are sectors that will do well. So from a double digit growth, if it slows even to a single digit growth, it will still be a meaningful kind of a growth going forward. And that's the read I would take from here.
Sakshi, which are the sectors particularly where you see that there will be some more impact or some more pain that may be visible on 1st of June when April month data will be out for IIP?
Right. So I think we'll have to look at some of the components within manufacturing. I think one that is clearly one space. So as I said, we're already beginning to see some impact on, chemicals, petroleum products, etc. Some of the derivatives, fertilizers. So I think these are spaces and sectors to closely watch. My prima facie, my forecast would be that we continue to see a moderation, further moderation in some of these sectors. Now, whether, by June, when we are in June and we are having this discussion on the April numbers and the other high frequency indicators, I think that's too far out right now. I think there are a lot of things that can happen during that time, whether, there is this conflict kind of resolves and some of these disruptions that we are currently witnessing kind of start fading off. And also it is very difficult at this point to map out the second round effects, right, that might play out. So right now we are talking about a handful of sectors where there is an impact on production that has started showing up. But if this conflict is prolonged, I think within the MSME space, we know the sectors, paint, tires, etc., especially sectors that are dependent on petroleum products and derivatives. Clearly, that stress can start feeding through.
Right. Anita, one last question to you before we wrap this particular discussion. What is your reading of now inflation growth dynamics? Of course, as Sakshi was mentioning that June is still far away, but you see that on-ground situation is slightly better than what was anticipated?
No, I think in terms of inflation, things are not getting better simply because of the fact that one, as we speak, crude is already back, over 110. And the fact that, it's not just about crude, it is about the logistics cost in terms of transit cost, in terms of insurance, in terms of the risk premium has become multifold. So that's not going to decline. And even if, Saudi Arabian FM has also said that even if the Strait of Hormuz opens, it could take several months for the risk premium, especially in terms of logistics and in terms of insurance, to actually simmer down. And as we speak, we already know that, fertilizer costs are over the roof, gas prices are still very high. So overall import cost of the Strait of Hormuz impacted direct commodities, energy commodities are already skyrocketing. And this will start feeding into the second order impact as we speak, simply because of the fact that right now, if we observe the PMI data, which just came out, we also saw that the PMI slightly improved in the month of April, which is largely, to my mind, driven by inventory buildup. So some of them are also building, some kind of cushion because prospectively prices are going to go up. So which means that if the economy kind of even shows this much resilience as we speak, then there will clearly be a pass through of the cost. So we cannot escape inflation, and currency related impact is also likely to flow through. So I don't think inflation is actually going to get better. It will likely remain very high. The tail risks are very, very high for inflation. And our estimate is actually around 5% for FY27, much higher than RBI's estimate.
Definitely, that is something to watch out for. In fact, Reserve Bank also did mention that the risks remain. Now, with this, it's time for a wrap in this discussion. Thank you so much, Sakshi, as well as Anita, for joining with your views on IIP.